When it comes to funding your e-commerce business, understanding how financial products work is crucial. One common question that arises for Shopify store owners is whether Shopify Capital charges interest in the traditional sense. The short answer is not exactly in the way a typical bank loan does. Instead, Shopify Capital uses a different fee structure. How it works for beginners. Shopify Capital offers funding to eligible merchants primarily in two forms: merchant cash advances and loans. While they share similarities, their fee structures differ from standard bank loans. 1. Merchant cash advances, MCAs. What it is. With an MCA, Shopify essentially buys a portion of your future sales revenue. You receive a lump sum of money up front. The fee, not interest instead of an interest rate. Shopify charges a fixed borrowing fee, sometimes referred to as a factor rate. This fee is a predetermined amount added to the original advance. For example, if you get a $10,000 advance with a 1.13 factor rate, you'll owe a total of $11,300. That extra $1,300 is your fixed borrowing cost. Repayment. Repayment is flexible and tied directly to your daily sales. A small, fixed percentage of your daily sales, known as the remittance rate, is automatically deducted until the total agreed-upon amount, original advance plus fixed fee, is repaid. If you have a good sales day, you pay back more. If sales are slow, you pay back less. There's usually no strict deadline for repayment with MCAs, as it depends on your sales volume. 2. Shopify Capital loans. What it is. These are more akin to traditional loans, but still operate within Shopify's flexible repayment model. You receive a lump sum with a clear repayment term. The fee, not interest similar to MCAs. Loans also come with fixed borrowing costs up front, determined by a factor rate. The total amount you owe is the loan amount plus this fixed cost. Repayment. Repayment is also a percentage of your daily sales, automatically deducted. However, unlike MCAs, Shopify Capital loans often have a maximum repayment term, e.g., 12 or 18 months, and may include milestones where a certain percentage of the loan must be repaid by a specific date. If your daily sales deductions don't meet these milestones, you might be required to make a manual payment. Key differences from traditional interest. Fixed fee versus compounding interest. With traditional loans, interest typically accrues over time on the remaining principal, meaning the amount of interest you pay decreases as you pay down the loan. Shopify Capital's fixed fee doesn't change regardless of how quickly you repay. Sales-based repayment. The automatic daily deductions tied to your sales offer flexibility that traditional fixed monthly loan payments don't. This can be a huge benefit for businesses with fluctuating revenue. No personal credit check. Shopify Capital usually bases eligibility on your store performance and sales history, not your personal credit score. Before accepting any Shopify Capital offer, carefully review the total amount to be repaid, the lump sum you receive plus the fixed borrowing cost, and the remittance rate, the percentage of daily sales that will be deducted. Calculate what this could mean for your cash flow during slower periods. While the flexibility is appealing, the effective cost can sometimes be higher than a traditional loan, especially if you repay it very quickly. Understand the full commitment before you proceed.